This is Amy Zimmer from Hall & Hunter Realtors with your real estate term of the week. A 1031 exchange is a transaction sanctioned by the U.S. Internal Revenue Service that allows a seller to swap one like-kind investment property for another when buying one of equal or greater value as a means of deferring capital gains taxes. The complex process, which is handled by professionals, gets its name from the section of the Internal Revenue Code that authorizes it. When completing a 1031 exchange, you can't just sell one property and eventually acquire another. In order to complete an IRS-compliant 1031 exchange, there are two important time limits you need to keep in mind. You'll have 45 days from the sale of your original property to identify potential replacement properties. You can identify as many as 3 like-kind properties to buy, or as many as you want if the combined value doesn't exceed 200% of the sale price of your original property. These properties must be identified in a written document and clearly described with the property's street addresses or legal descriptions, and this document must be delivered to your exchange facilitator. You have 180 days from the sale of the original property to close on the purchase of your replacement property or properties. This is when the entire exchange process needs to be completed. These timelines refer to calendar days, not business days. And if there's more than one property involved in your 1031 exchange, the clock starts when the first property is sold. The IRS requires you to use an impartial third party to set up the exchange for you, known as an exchange facilitator. According to the IRS, your exchange facilitator can be a qualified intermediary or a transferee, escrow holder, trustee, or other person that holds exchange funds for you in a deferred exchange under the terms of the escrow agreement, trust agreement, or exchange agreement. You'll want to hire a reputable and experienced qualified intermediary, or QI, to facilitate your 1031 exchange. This is a person or company who will ensure that the 1031 exchange is completed properly on your behalf. A qualified intermediary cannot be a real estate agent. It can also not be a relative or a person who is related to your real estate agent. Anyone in one of these groups is known as a disqualified person. In simple terms, a qualified intermediary must not have any major conflict of interest in the transaction. There's a lot involved with completing a successful and IRS-compliant 1031 exchange, so make sure you have a handle on all the steps and timelines. In order to complete a 1031 exchange, you'll likely need to use the services of 3 qualified professionals: real estate agent, an exchange facilitator, and a tax advisor or attorney. It's important to have a qualified tax professional to help guide you through the 1031 exchange process, as well as the process of filing your tax return after you've completed the exchange. A 1031 exchange can be an excellent tax strategy for savvy real estate investors, but it's not a simple process. Be sure you know the process well and that you enlist the help of qualified and experienced professionals before you attempt to complete a 1031 exchange in your portfolio.